Well, good afternoon, everyone from Denver. I'm Chris Shepard from Denver South, and I'm joined here today by our friends from Riot, and we are presenting Creative Connections to Startup Capital. Denver South has been partnering with Riot over the past 6 months to provide educational opportunities on what startups need as they are entering communities. And we started with kind of what organizations startups should be engaged with. And then we went to how to work with jurisdictions and large companies to bring your projects to fruition. And then this presentation at the end of the year is how to find capital. I mean, that's what we always hear from the startups in our region when we talk to them. Besides finding customers, the other thing is how to find startup capital. Here in Denver South, we are creating a community around our entrepreneurs. We haven't had a very strong one in the past. So this is why we're working with Riot to make sure that we are putting together the pieces that that our entrepreneurs need. And I'm missing my CEO and president today, Tom Brook, because he is joining the Rockies Venture Club for what he's an advisor on one of their funds. So he is there today, and we engage with a lot of the capital providers in the region, but we thought this was a really good way to discuss other ways. Riot and Pat and Rupak both have some really good ideas on what entrepreneurs can do to find additional capital to grow their companies. So just for all of you who aren't familiar with Denver South, we are a regional economic development group that's located south of the city and county of Denver. So we go along the I-25 corridor and we cover 5 different jurisdictions, 3 cities and 2 counties. So we're pretty large. We're a really significant employment center of the Front Range of Colorado. But again, we have a lot of corporations, but not as many entrepreneurs as we would like. And that's what we're trying to grow, because that is the future of our workforce and the future of what corporations look like, our startups these days. So I am going to go ahead and hand it off to Rachel Newberry with Riot and look forward to hearing what Pat and Rupak have to say.
Thank you so much, Chris. Good afternoon, or perhaps good morning from wherever you're joining us, everyone. My name is Rachel Newberry. I am the program director at Riot. We're really pleased to be partnered with Denver South to bring you this event series. As Chris mentioned, this is the 3rd in a series on connecting entrepreneurs to critical partnerships that they may need, whether that's the public sector, industry partners, or today, capital. And capital is certainly a very critical resource that entrepreneurs are interested in tapping into. A little bit about Riot before we jump in. We are a 501c3 nonprofit, and we are focused on economic development in emerging technology spaces. We run a startup accelerator, for example, as one way to support people as they venture out on their own to be their own boss and create jobs and grow new technology ventures. And then we also support large established corporate companies with pursuing new business opportunities in emerging technologies and areas of innovation. So ultimately, we care about job creation and company growth, and again, critical resource in doing so is in helping people to connect to funding sources to help them accelerate their growth even further. So my background is in startup support. A lot of this discussion today with Pat and Rupak is around how entrepreneurs can creatively connect to capital sources. I am passionate about helping entrepreneurs tap into the resources that they need to grow. And Pat and Rupak are going to shed some light on different funding vehicles that can be one of those really important resources. Before we get started, and I'll welcome Pat and Rupak to the stage, I'm going to launch a really quick poll just to get a sense of who's in the room today. As I launch this here, you'll see a question around, what identifies you? Are you a startup that has raised capital or is interested in raising capital? Or are you perhaps an organization that connects entrepreneurs to capital or has even raised a fund for startups. If you're none of those, you can feel free to opt out of this poll, but this will help us to tailor the conversation even more. So I'll let some folks get their answers in. And while that's happening, I am pleased to welcome to the stage our guest for this panel discussion. We have Pat Gouhin, CEO of Angel Capital Association. Pat has a deep view into the angel investing space across the country. And then I'd like to welcome Rupak Doshi, CEO of Omnisync, a really interesting new platform that helps startups connect into non-dilutive funding sources such as SBIR and STTR grants. Welcome, Rupak and Pat. I'm glad to have you here.
Glad to be here.
Great.
Thank you so much, Rachel.
Absolutely. Glad to have you. I just closed our poll out. It looks like, I'll share the results quickly with everyone. Looks like we've got about 20 to 30% of folks in the room are entrepreneurs that have raised capital. Same thing, between 20 and 30% of folks are organizations that connect entrepreneurs to capital sources. But our large majority here, we've got about 70% of folks in the room are entrepreneurs that are planning to raise capital. So I think you all are in the right place, and hopefully we'll have some good insights to share. So to get us started here, Pat and Rupak, I'd like to give you both an opportunity to introduce yourselves and talk about how your organizations help connect founders to sources of capital and what that looks like for you. So Pat, perhaps I'll hand it off to you first.
Sure. So thank you very much, Rachel. And ACA is the Angel Capital Association. My name's Pat Gouhin, and I am the CEO. And we are a professional society. So we are made up of 15,000 accredited investors that belong to about 250 angel groups. Most of those are in the US, but a few of them are international, and they're throughout the US. So unlike kind of the VC community that's heavy on the coast, we've got representation there, but we also have a lot in the flyover states as well. And we just recently published what we call our Angel Funders Report, which is filled with facts, figures, stats on what's going on specifically within the angel community. And I'm happy to report that we've had our best year ever from an investment standpoint, in that those 15,000 accredited investors in 250 groups have invested $650 million into about 3,500 startups or so.
Incredible.
So I'll stop there for now, but some exciting stuff to tell you about.
That's great. Yeah, it's like Chris mentioned, entrepreneurship is really the future of the workforce and of economic resiliency. So I'm glad to see that folks like the groups that you work with, Pat, are investing in those startups that are a critical part of kind of recovering from COVID, right? So lots of good stuff. So Rupak, tell us a little bit more about Omnisync and yourself.
Yes. Yeah. So I'm the co-founder and CEO of Omnisync. Omnisync is actually a startup company out of San Diego. But we're fairly far along compared to most companies that we work with. So we've raised VC funding, as well as we've actually gotten grants for ourselves as well. So we walk the walk and not just talk the talk. But essentially what we did was something that we're basically disrupting the space of startups being able to mine the government for that initial pot of R&D funding to fund the technology development or the product development efforts within their company. So this is the stage where you go to investors. Investors will tell you you're too early, show me some traction. And the founders are like, how do I show traction if I don't have any money? That cycle of death, as a lot of people say, where we set up our product to essentially cut through that vicious circle. And what's great about government funding is essentially it comes debt-free and equity-free. And so it's pretty amazing if you think about that kind of money. Plus, there's a lot of it. There is $4 billion every year that gets awarded to thousands of startup companies across the country. And we've essentially democratized that process to then not have all the money go towards people who just know how to do it, or people who can pay consultants a lot of money. So we are essentially the disruptor in the space, because we've designed an affordable software platform combined with services to make it really affordable and possible for a lot of applicants, especially first timers, to actually go through and win in this game. So.
Fantastic. Yeah, I love that. I think non-dilutive capital can often be overlooked or not really fully understood, but is a great vehicle to consider. I'd like to kind of start our conversation with baselining the different types of funding vehicles that startups can pursue. Because, as we see here, Rupak mostly working in the non-dilutive space, Pat in the angel investing space. I think oftentimes the kind of shiny object is venture capital, and startups think like that's exactly where they should go. But really, VC funding is kind of sprinkled on top of sales, right? So as entrepreneurs are at different stages of development, what are the different kind of funding vehicles that they should consider? Pat, maybe I'll start with you on the equity capital side.
Sure. So, we like to say that generally as a founder, you're probably first going to go to friends and family, right? After you've tapped all of them out, you may not have revenue yet, probably can't go to the bank, can't get a loan. Probably VCs aren't going to pay attention to you. So where do you go? Well, you go to the angel community. And we, in many regards are similar to the VC community, but in many regards different. And how are we different? Well, namely, many of the angels are former entrepreneurs themselves. And they're doing this not only because they want to get a financial return, but because they feel good about giving to their local community and helping, those entrepreneurs who, they might have been in their shoes 20, 30, 40 years ago or so. So my first bit of advice is to look at your local angel groups. And in the Denver area, Rocky's Venture Club is one of the best in the country. Fantastic. Understand the difference in formats, in that we have groups that are made up of what's called a network, just a bunch of individuals that all invest on their own or as part of a fund where there might be general partners and then a number of limited partners, and they kind of collectively determine where they're going to, put their money. And then, of course, we have solo angels that are just kind of, doing it on their own, but they're really, the minority. Most folks belong to kind of that group mentality. And then we're starting to see some new models emerge. One specifically is revenue-based funds. So if you're not ready to give up that equity, but you've got revenue and you're willing to cut a deal that the bank won't give you, you can probably find a group that would work a revenue-based deal, with you. We're seeing some other models. Obviously, crowdfunding is another way, that entrepreneurs can go out there and get that initial funding. As Rupak said, if you can get that non-dilutive government grant, and there are literally dozens of federal agencies in all the different areas that have SBIR programs that, they have these different cycles, different amounts in that, but that's a wonderful way to get, started and make sure that you're kind of getting the capital that you need to seize the opportunities that are there, but also look to that relationship that you build. Those 15,000 members that I mentioned, we estimate that they volunteer 1 million hours a year into their local community, working with accelerators, incubators, and helping entrepreneurs figure out what to do, when to pivot, where to go, using their network and all that. So it really is a great resource that is more than just the capital. It's also about that, the network and the intellectual, capacity that comes with it.
Absolutely. Yeah. Thanks for that comment, Pat. I think as we advise startups that come into our accelerator program and they're looking at raising funds, we certainly say, it's not just the money that you're looking for. You're looking for solid advisement and people that have good experience and expertise that they can bring to your company as well. Pat, really quickly, can you talk a little bit about like the differences between angel capital versus a venture capital firm?
Yeah, generally speaking, we would say that the VCs play higher up the food chain, although that's not necessarily true, and that we're seeing them develop bigger and bigger funds, but also come down into the micro VC stage as well. And so, and this is one of the other, kind of feedback that we get out there is some of these VCs that are moving down, it's all about diversification. So they will cut deals in a very timely manner with entrepreneurs, start to finish. And I've heard everything from 5 days to 9 days and so forth, where if you're dealing with an angel group, they're probably going to dig deeper, which I would say in the end is going to be more valuable to you, because if they're going to put their money there, and again, keep in mind, it's their money, their after-tax dollars, as opposed to the VC that's using somebody else's money. Right. So there's a different emotional, pull to it, but they're going to make sure that they have a relationship with you, that they go through proper due diligence. And that necessarily takes time. Some groups are quicker than others, but just know quick money is not always the best thing that you need. One other point is, I would say, from what I've seen, there's a lot more collaboration within the angel community, meaning the ability to syndicate deals. So you might go to your local angel group, you might be raising $1 million. That particular group might be in for 250, and you say, oh my God, I got to go do this 4 times. Well, if it is one of the more seasoned, established angel groups that has relationships across the country, they can help you out as a founder, because they're going to call up their friends in the next city and say, we got a great founder, we got a great deal, we're in for 25% of the round, we think you guys should take a look at this. And then, they can pass on their due diligence documents and kind of streamline that process. So for you as the founder, it's not 4 times the amount of work to go to 4 different groups and each of them, provide funding.
Fantastic. Thanks, Pat. Rupak, what are the common options that you see in the non-dilutive capital space? I know there's been some discussion around SBIR and STTR, but there's lots of other grants and competitions as well. So what are you seeing in non-dilutive capital?
Yeah, exactly. So, the federal programs are one of the big sources. That's like the 4 billion plus every year that goes out. In addition to that, there's a bunch of corporate grants that I'm now seeing coming out. So, Cisco has a program, and every large tech company seems to have a grant competition out every now and then for attracting startups that are working in a similar area that ultimately benefits their overall core mission. And they essentially just want to fund that company to be in their ecosystem. They have accelerator programs nowadays as well to support those companies, as well as then they take it forward through corporate strategic funding afterwards, if they actually are able to build something of value to them. That's the other thing that I'm seeing a lot more of nowadays. Like every single tech company having a kind of like a venture arm that actually starts with a grant and then goes into more of the equity side of things. One often overlooked source of early stage funding that I actually think for entrepreneurs that's like really important to tap into is the whole community-based funding. So these are organizations or places like Kiva and GoFundMe. So I've actually seen quite a few entrepreneurs get that first pot of 5K, 10K, 20K to get their stuff off the ground, actually get it from there. That's completely non-dilutive, right? They don't take equities. It's like Kiva is actually a microloan, but for the most part, GoFundMe, completely free donation, right? And the way the platform works is that they actually optionally charge the donors if they want to opt in and match if they wanted to. So that's another option that I see often overlooked. Apart from that, a lot of states have programs that are kind of like, sometimes they're matching dollars on top of anything else that you win, but sometimes they're completely free seed money from the state as well to basically foster innovation ecosystems. Obviously, that's lesser than in California and Massachusetts, but a lot more other states have a lot of those programs because the startup ecosystem isn't as robust in those places. So, and then the government wants to support that. So that's another option that exists as well. In crowdfunding, there's actually 2 pathways, right? So one of them is actually non-dilutive. So the equity crowdfunding is dilutive. Obviously, that's the WeFunder, Start Engine, Republic kind of pathway where you actually give out equity. And then the other option is if you have a possible prototype that's within grasp, then you go to places like Kickstarter where you can actually pre-sell product to get funding, right, to build your product. So that's another non-dilutive pathway that some companies that have some kind of tangible thing that they can actually make with the money they can take that route as well.
Hey, Rachel, if I could just quickly add to that, Rupak mentioned the state programs that are out there, and there are a lot of great state programs, including Colorado. There's a chat about North Carolina, another great one. But right now, the U.S. Treasury Department is going through a special program called SSBCI, which stands for State Small Business Credit Initiative. And they are pumping $10 billion into all 50 states and U.S. territories. It's allocated, proportionately, but I think the smallest state gets something like, 50 million or something, up to several hundred million. And the states have to apply with a plan on how they're going to utilize those funds here this month. And then they'll have, I think it's the next 10 years to kind of allocate their proportion out. There is a matching contribution, but that's definitely something that, you know, you'll want to look into your particular state. Unfortunately, there's no cookie cut approach, 50 states doing it 50 different ways, but see how much funding they've got, how it's being allocated, and how you might be able to tap into an angel or VC, you know, to get some share of that.
Awesome. Thank you, Pat. Yeah, for all the entrepreneurs in the room, I'd be like taking furious notes. There's lots of options on the funding side, which is really exciting, but can be kind of tricky to navigate. So I think it's really important, but often overlooked, that entrepreneurs should align the funding vehicle that they pursue with the current critical development milestones of their company. So my next question is really around how can entrepreneurs assess what funding vehicle might be right for them? And yeah, Rupak, maybe I'll start with you. Like, how does a startup kind of determine if they're a good fit for grant funding or some of these other vehicles, versus venture capital or angel funding? And then Pat, I'll ask the same to you.
Yeah, I mean, there's lots of ways of doing it, and a lot of them are subjective. I, coming from a research background, I like to take the objective approach so as to not bias out decisions. So my best advice for entrepreneurs is find your competitors who are slightly ahead of you, and then look at how they got funded. And every one of these sources pushes out previous awardees, be it federal grants or SPRs. There's a whole database of how you can search up everyone who's ever won an SPR before. Through keyword searching, we actually have a tool that can do contextual searching using paragraphs or blurbs of companies. You know, you can actually go into all of these state programs. Obviously, all the crowdfunding things all public as well, because they have to raise it publicly. So all of these avenues, they basically publish who's been winning all these things, and find your closest competitor and figure out if they've actually been successful in those avenues. And chances are you'll probably be successful too.
Yeah,
that's like the most objective way of doing it without biasing yourself or anyone's personal opinion into that. But obviously, when advisors are involved, then they obviously have their own advice to give you as to like who to go after, where to go after. And that depends on what stage you're at, what kind of a company you are, because some kinds of companies are suitable for some kinds of funding options and other kinds aren't. And so a lot of that is very, very subjective, right? So.
Yeah, absolutely. Yeah, I think just to comment quickly before I hand it over to you, Pat, the kind of two big buckets that we often advise startups around is if you're at a point where you're still trying to get traction in the market, or you're perhaps even trying to validate your technology, then things like SBIR programs could be a good fit for that. Whereas a lot of startups we work with tend to maybe prematurely go after venture capital, and really, you know, they've got to be driving sales to be attractive to those kinds of funders. So yeah, just kind of sussing out, like, are you at a stage where you're validating your technology, or you're still, you know, piloting with partners, not yet driving revenue, or are you driving revenue and you need a way to kind of accelerate your capture of the market? So yeah, Pat, what are your thoughts around this? How does a startup kind of determine what are the right vehicles to pursue?
So I'm going to answer this from the angel group perspective, and I'm going to talk out of both sides of my mouth, meaning giving you some kind of conflicting information. We know angels like to invest locally. So the first thing I would do is start with your geographic center. And you can go to the ACA website. There's a member directory of all the different angel groups that are out there. Each of them has their own investment thesis and model. So you may or may not be the right type of company for them. If you're not, work, you know, going further and further out, you know, draw those concentric circles. We've definitely seen that because of the pandemic, groups that originally only had face-to-face meetings and only invested locally or whatever are now looking further and further because they can, and they were able to, you know, have these meetings with entrepreneurs and have success virtually. So that opens up a whole new world of opportunities, you know, to them. So do that. The other thing you have to understand is that, you know, most angel groups are probably going to look at pre-seed, seed, seed, Series A, probably nothing beyond that. So, this really is at the front end of that. They definitely prefer a C Corp as opposed to an LLC or anything else, because that's what starts the clock ticking when it comes to tax incentives, QSBS, qualified small business stock. So that is important to most. Generally, they would much rather get into a preferred equity round than a convertible note. But if they got to do a convertible note, to kind of make sure that they've got the runway they need to do the bridge before they can get to the next, equity round, many groups were accepting that. And we're seeing more and more convertible notes enter the mix. Depending upon the coast and where you're at, safes may come into play, more preferable on the West Coast, not so much, on the East Coast. So all of these things as an entrepreneur, you can set yourself up for success if you kind of know what that particular angel group wants to see. Same thing with different sectors. Depending upon the makeup of that group, they may have a strong interest in a particular sector, or they may completely avoid a sector. And that's not on you as the entrepreneur. You just need to know who you're dealing with and say, am I going to be a good fit for you? If they say no, ask why, and then say, well, do you have, any other colleagues or any other groups out there that you think might be interested in my type of company and everything? And we see a lot of those referrals taking place. And again, depending on the timing, depending upon where you're at, some groups have tons of deal flow, others don't. So it really is an exporting and importing game too. The final thought that I'll throw on this is valuation. That's very important. We've seen valuations rise. That can be a showstopper right there. If the angel group feels that your valuation is unrealistic, and again, West Coast and Coast deals are generally higher valued than those in the Midwest, but know your market before you go in there and pitch.
Fantastic. Thanks, Pat. Let me mention, oh yeah.
Sorry, Rachel, can I add one thing to that just to close out that discussion?
Please do.
Just one piece of advice I will give to all entrepreneurs is don't treat this as this is my right fit, I'm not going to do anything else. It's just not the right way of going about this. You will want to at least get to first base with all of these options, because you want to find out from the horse's mouth, as they say, right? If you're the right fit or not. So even if you think you're not the right fit for a VC, even if you're too early for the VC, talk to 10 VCs and tell them, let them know, I'm not ready for you yet, but I want to know, what do I need to do to get there? Yep. What do I need to show you to be ready for you? For my business, now you understand my business, what I'm trying to do. Do I need to hit $500,000 ARR? Do I need to bring a product out to market here, here, and here? Do I need to clarify this regulatory hurdle here? What stage do I need to be at to be interesting to you? Ask them that question straight up. You will know very clearly at that point. If they don't give you a straight answer, you just know that, okay, that's never going to work out for you or something like that. Or they will tell you, like, for example, when I went to certain VCs, they told me your business, no matter what you do, is never going to be the right fit for us.
Yeah.
Right.
Hey, Rachel, I did see there was a question in the chat too about B Corps and what are you seeing there? So again, I would go back to that Angel Funders report, lots of great data in there. I'm looking at the chart right in front of me. From all angel investments last year, 88% of them went into C Corps, 11% went into limited liability companies, 1% into B Corps, and 0% into S Corps.
Very interesting. Cool. Thanks for those insights. And I'll mention to the audience too, we're going to jump into some Q&A in just a few minutes. So if you have questions, please add them to the chat and we will get to them. But yeah, really good notes from both of you on, leveraging your network, seeing what others before you have done, just building relationships with investors to understand how you can progress and kind of determine if you're going to be a good fit now or later or never. And I also think that we'd like to highlight that, like, all money takes work, right? Founders are trying to drive revenue, hopefully first and foremost, because that's how you have a real business. But pursuing these other kinds of funding vehicles is not a replacement of driving revenue, and it's also it's a ton of work. So my question to you both is, what can founders expect as they're engaging with an angel group or a grant program? Like, what kind of effort and things do they need to have teed up to successfully progress those conversations?
Well, I'll start. So risk, right? I mean, any of these investments come with a whole lot of risk. So you can expect the angel group to kind of really drill the founder on that. Now, if you've been through one of these SBIR programs, that's wonderful because it's non-dilutive and the angel has a feel that, hey, the federal government's behind this. They went through a process. There was an application. They, the high-tech research, they watched them, they mentored them and all that. So they love that aspect of it. And that really, can improve the chances that you will get that follow-on funding from angels.
Yeah, so I can talk about this very personally as well, because I am a CEO of a startup that has gone through zero to wherever we are right now. And I can tell you your one biggest job as a founder is to ensure that your company never runs out of money, which basically it's not developing your product. It's not anything. It's basically to make sure your company never runs out of money. That's the one big job of a CEO, right? And basically you will be working on aspects of fundraising forever in your startup for 30% of your time every week, regardless of whether you're fundraising or not. You will always be fundraising. You will never stop. During active fundraising campaigns, be it like when you're actively raising or whatever, that time component can go up to 80% of your time. Like your calendar will be full of meetings with investors all day, all week for 3 months or whatever. So that's why you need to raise enough money to be able to support the people who can still run your business so that you can still go out and raise more money, right? But that's something that, so time commitment wise, this is not a one and done deal. Too many founders go in thinking I will get this money once and I'm done and I'm going to go build a great business. It's just not how it was. It's part of your job. It's the biggest part of your job, full-time job. Right?
Yeah, and not to mention, there's a lot of work that goes into raising the money, but then after the fact, say you close a round, then you've essentially hired a boss, right? So whether you're reporting to a grant funder or reporting to your investors, like there's work on the back end of that to maintain that relationship well, right?
And then you've got to get to the next step. So as soon as you win a phase 1, you're immediately working on a phase 2. Or if you've gotten an angel round close or a seed round close, the next day you're making your milestones for Series A.
I would offer 2 more tips on, increasing your odds for getting funding. And the first is in that pitch and presentation, have a very clear exit strategy, because keep in mind, angels don't get paid unless there's that liquidation event. So they're not interested in a mom and pop lifestyle business. They want to know that you're thinking 3, 5, 7 years, something like that for that exit. And to a point that Rupak made, the more rounds that they go through, the more diluted those early investors get. So they really like fewer rounds. If they think you can get, revenues to a point where you can then get a multiple of whatever, 5 or 10x, and they can get that early return in 5 to 7 years without being diluted, they love that. And then the final area is, and this is sometimes a surprise, but the number one thing that they're investing in is you, the founder, right? The management team. And so it's about coachability. They don't want the person that has all the answers and, is just going blindly ahead on their plan. They really want ownership in this. They want it to be a relationship and they want it to be mutually beneficial, meaning listening both ways. That's
great, Pat. I think the coachability aspect is a key characteristic that we look for as well, and just bringing startups into our accelerator program. Because to your point, those founders are the ones that are going to get the most out of the resources in front of them, because they're going to lean into feedback. They're going to be a sponge. They're going to listen to a variety of perspectives. So really good point. Pat, maybe sticking with you, you work with upwards of 250 angel groups across the country, right? So what are some of the trends that you're seeing in the angel community moving into next year?
Well, I've got another sheet right in front of me, so I can give you some specifics. I already mentioned that we saw the biggest year with 650 million invested. The average per angel group is 4.7 million per group, and that was an increase of 15% from 2019. What we also saw was that those funds are leveraged at a factor of about 6x, meaning those companies that the angels invested in, 650 million, went on to raise 4 billion. So, there's, I think, visibility. Those that get that early angel funding have more appeal and attention within the VC community. Additionally, we saw the number of deals that they invest in go up almost 30% to about 19. Now, because they put in more money in more deals, the average went down. The average deal size was about $245,000. And then from a diversity and inclusion standpoint, we've also seen some significant gains, much more so in the angel community than the VC community. I mean, we're just able to move the needle quicker. So specifically, when we talk about women, we saw two things happen. One, we've now seen 29% of the funded companies be female founders, not at 50%, but moving in the right direction, and 93% on a dollar versus their male counterparts is what they raised. So we're starting to see equity in the level as well. When we look at Black CEOs, what we found there is that relative to initial funding, they've now received 15% of the initial round capital. It was 1.5% 2 years ago, so a 10x increase in 1 year. And that was very clearly because there was a very heavy emphasis by ACA as well as by all the angel groups to say we need to do more. And not only in investing in underrepresented founders, but aggressively going after new investors that are also from underrepresented categories, because we know that helps the whole pipeline flow better.
Yeah, fantastic. Thanks, Pat. Rupak, on the grant side, and maybe particularly with federal opportunities, I know there's a lot of COVID relief funding, the Build Back Better plan. What are the trends that you're seeing into next year on grant funding?
Yeah, basically what we've seen this year is the amount of money has gone up for every single agency. Almost every single agency, basically the phase 1 standard grant went up by 30 or 40%, all of them. So if it was 100K, went up to 150, it was 200K, went up to 250, right? So all of them have gone up, which was really, really cool to see. And even the larger grants, even phase 2s, they've gone up from $1 million to $1.25 million, $1.75 million sometimes. It was great, right? See, the other thing we've also seen is that the agencies have actually taken the anti-VC approach almost, where they're actually, what they're saying is that, we're going to fund entrepreneurs who are trying to build hard, really hard things, which take time and effort, as opposed to traditional investors who will fund things that are low risk, right? Like apps, a lot of app companies, right, that get funded, a lot of tech companies. So a lot of agencies actually are in fact putting this in their solicitations, that if you're just a mobile app, don't bother applying, things like that. So there's a lot that's going on with the agencies, but they actually want to fund because their goal is employment, right? So what they've said is if you're a manufacturing unit, eventually, then you will hire many more people. If you're someone who has really hardcore hard tech, then your IP will be much more defensible. Software companies barely have any IP for the most part that's defensible, right? So there's a lot of that going on with agencies, which is nice to see because it brings about diversity. So we did have a lot of app companies that did win, but they had to take the approach of proposing innovations that expand their companies to more beyond just traditional tech company that has one software product or one mobile app that can be quickly downloaded.
Yeah, that's really encouraging. I think at Riot, we tend to work with a lot of companies that have proprietary hardware.
Right.
It's capital intensive, so the
right.
Funders are a little bit scared of that. So yeah, glad to hear that on the federal funding side, there's more kind of lean in to support those companies that have maybe a longer ROI than others. With both of you, Rupak, I know you have a lot of personal experience and raising funding from a variety of places with your company, and Pat, you see tons of investment happening. What are some of you've already offered some great advice, but what are some kind of top things that founders should keep in mind as they are positioning themselves for funding? One example that comes to mind for me is that I think we see a lot of founders that just go in and ask for a number, like, okay, I'm trying to raise 750,000 seed fund, period. And they don't give a good argument behind that to how that gets them to the next critical milestone and starts to kind of exponentially grow their company. So tactical things like that, what do you think founders can do better to position themselves well?
You want to start, Rupak, or you want me to?
No, I can start there. So one thing is you've got to know what you want from that investor, right? Like if it's just the money, then you go in plain with the financials, and because you know that's what they care about. If you want that, if that's the kind of investor you want, that they give you money, hand off, and they go off, do something else, you go off, do something else, you never talk to them till you exit, then you purely go in with financials. Here's the financials, here's how it'll make you money, here's the 5-year plan. Do you believe it? If you believe it, give me the money, right? That's one way of doing it. That's not the preferred way of doing it, because traditionally what you would do is you would basically have a plan of how do you, like Rachel said, like that now for my business, I need to get to this next milestone to make that next step. Be it if you're a prototype, I need to get this tested, implemented, get the data, and then scale. Or if you're at idea, you need to get a prototype. If you're at a working product that's in the market, then you need to go from maybe 1x to 5x of your current revenue or whatever. Then you need to build a go-to-market team, or you need to build a BD team. Then you need the money for sales, whatever. You need to know very clearly what your next business milestone is. And that's where you basically go out and you basically couch your story around how any amount of money that you, and everything that you're doing, that the one mission is how to get to the next stage. And there's nothing else that's going to distract you from that. That's all you need to do. That's all the money that's going to go towards. It's not going to go towards anything else at this point. And that's the best way of raising money, because the investor can clearly see that's where the money is going. And the next milestone, when you hit, will increase your valuation for the next round, right? That's kind of how their money grows. If you think about traditional investing in stocks, right? They want to see their money grow. And so the only way at this stage that they're going to see their money grow is if your valuation goes up, and your valuation will go up if you hit your next milestone. It's just as simple as that, really. And same thing for grants, right? For grants, they want to also know what stage are you at? What will you need the money for to get to where? Specifically for SPIRs, they want to fund research. And so you want to tell them, I need to do this R&D to get to this stage with my product. And that's where the product will be able to do XYZ, which is really important for this community of ABC people, or whatever.
Great.
So, I'm going to stick with my original answers there of, I think the two biggest things are having that exit strategy and making sure that you are coachable. However, to that, I would add the valuation thing. I see that being a sticking point, all the time. And I've only been around doing this in this space for about 3 years or so, but I am very impressed with the professionalism and the integrity of the angels, meaning they will not take advantage of an entrepreneur. They're there to try and cut the best deal in a truly win-win situation. And, they'd like to get 20, 30% equity in that round. They don't want, 50+%. They want to make sure that you, the founder, are motivated, incentivized to do what you need to do, and that you have enough of a pool for the management team that you're going to need to hire. So I think they will often come back and say, hey, look, we know you think that valuation is realistic, but maybe it is in San Francisco or Silicon Valley, but it's not in Boise. And here are the reasons. And even if we agreed to that, it's going to set you up for failure, because then you're likely going to be headed for a down round, and then you're going to have a reputation associated with that. And so I would just say, really look and listen to those angels, because I do think they've been in your shoes and they are, looking out for you. And then the final area is after you get that money, reporting. So often I hear groups say, oh, we funded that company, we haven't heard anything. What's going on? Whether it's positive or negative, they really want to hear. And then what happens is time goes on, you've got to pivot or whatever, you don't have the runway you need, you come back, you need more cash. And they say, well, wait a minute, where have you been for the past 2 years? I haven't gotten a single report. I don't know how things are going. So, the best communication I've seen is when there's a regular report, whether it's monthly, quarterly, or whatever, and there's a specific ask. Here's the success we've had. Here's the challenges we've got. Here's what's coming up next. Can anybody help us in these areas? I mean, it shows your authenticity as a founder that they really like.
That's right. And it's also part of that, leveraging the relationship, not just the money. So how do you help your network work for you? You've got to be clear about what your asks and your challenges are. Yeah,
I'll tell you, no news, investors automatically assume is bad news. So, you'd rather just tell them. And I can tell you from personal experience, I haven't been able to get back to investors in 2 months. They know I reach back every month. And just because I was busy, really busy, because we had a ton of work to be done, things were going really well. but they all reach back out to me. What's wrong? What's going on? What's the problem? Because automatic assumption is things are bad.
Yep, absolutely. So yeah, communication is key. Great. Well, I'm going to open it up to audience questions. So if you all have anything you'd like to ask Rupak and Pat, please drop it in the chat. Before I hand it off to Chris to facilitate that Q&A, I've got one last question, and I want to take it back a little bit earlier in the startup process. So before a founder is considering, what funding vehicle or what kind of growth capital to pursue, where should their focus be? Like, what's your advice for, number one priority before a founder is at a stage where they're looking at raising money?
I think that's somewhat dependent upon the sector, meaning the sector you're in, may dictate the critical importance of given tasks. And I'm thinking like, medical devices and things. If there's a regulatory requirement or whatever, that's huge risk, right? So that's important. What intellectual property, do you have, and has that been, secured? So those are kind of, the obvious things there. But I don't know that there's a flat out easy answer, to that one. Just be aware of all the risk that's out there, the changes that you're going to have to make, keep your eyes open and, pivot at the right time.
That's right.
I have a straight answer to that. Go through Lean Launchpad or Lean Startup.
Yeah.
Like that one thing that every company needs to do before they go out and do anything else with their company. Because when you talk to those 60 or 100 people, you will get a very, very clear idea where you are in the marketplace, what you need to do to be successful, what customers are looking for, and what hurdles other people have had in your space. Like you will have a very clear idea about, if you do it right, obviously. So go through, like read Steve Blank's book or whatever, and go through the Lean Startup method.
Yep.
No better thing to do before you go out and build a company.
Absolutely. That was really the answer I was looking for. I might have been leading that a little bit, but yeah, talk to customers. I think so many entrepreneurs neglect to just deeply engage in their market, and you can't possibly understand if you're solving the right problem with the right solution unless you're talking to customers. So great advice from you both. Well, I'm going to welcome Chris Shafford back to the main stage, if you will. Chris, any questions in the chat that we should address here?
Sure, Rachel. One of the ones that I came up with, Pat had said, you had said something about there's different options when companies are going out to raise capital, and not all of them take equity. Could you put a little more focus on that to talk about some of the other options? Because we find that as we work with startups in Denver South, that they have a fast growing company, they could exit, but they really don't want to. They want to keep growing it. They don't want to give up equity. So what are their other options?
Well, certainly there's all of the SBIR funds, whether they be federal, whether there's similar grants at a state level. There could potentially be private foundation grants, depending upon what the area is that you're working on. The one I specifically mentioned was revenue-based funds or revenue-based initiatives, which I think really got its start in the entertainment industry because it's a different kind of model. But the concept here is that, hey, I think I'm really on a roll as a founder. I've got some revenues, so I don't want to give up any equity, but I've got the leverage now that I can go get perhaps more capital from an angel under an RBF deal than I can going to the bank. And so they'll sit down, they'll negotiate with you and figure out the terms. Like, I want 6% of your monthly recurring revenues and a 2x return. So once you've paid me 2 times whatever my initial investment is, whether it's 1 year or 5 years or whatever, deals over. So we're seeing more and more deals like that, kind of pop up. And then, quite often you'll see those tied into the social impact space. But if there's that double bottom line advantage, sometimes there's some creative structures that come with that too.
Great. And someone also asked, go ahead, Rupak.
Yeah, sorry, I was just going to mention something specific. So if you're a SaaS company, so if you're a high growth, startup that is about to exit or whatever, maybe applying for grants and contracts is too much work for time to put into. If you're at that stage, then at that point, you might as well consider these revenue-based financing options. So the ones that I know on the top of my head, If you're a subscription-based business, then Pipe and Clearco are really good to try for. If you're other kinds of business, then I know QuickBooks, if your bookkeeping is on QuickBooks, for example, QuickBooks Capital will already reach out to you, for example, if they see consistent revenue in your books every month. Stripe Capital also does the same thing. If your payments are through Stripe, they'll reach out to you as well. Those are small amounts. And something that there's word on the street, and I know that's because we partner with them, but basically WeFunder, which is the equity crowdfunding campaign, they actually now have a program where you can raise money from investors, but with the model where you actually just pay them back in terms of revenue for whatever dollars they've invested in. So within like a 2-year time frame or whatever. So that way you can raise more money, but still it's kind of like revenue based because you're paying back with revenue as opposed to giving them equity or whatever. So that's an alternative option that some of these crowdfunding platforms are taking out. So that are some of the specific things that you can actually go after.
Wow, those are interesting. I didn't know they existed. Thank you both on that. So we have a question. Someone has a co-founder who's unwilling to leave their full-time job until the startup can offer an equivalent salary. How's it look to investors? Is it a red flag or is it kind of normal?
Pat, do you want to take that from an investor's view?
Yeah, that definitely throws up a flag. I mean, and again, I hear this all the time. If you as the founder are not sure enough of this and willing to risk, what you're doing, why should I as an investor back you? So, I mean, that is a real hurdle that you've got to figure out what your story is or why you're not 110% in.
And this is a real problem. I mean, I understand both sides of it. So for example, I had a full-time job before I started Omnisync, and I did not, I mean, I thought about starting a company for a long time and I didn't because I had a family and I had to get paid. I totally sympathize with the scenario. It's not easy. And the only reason we started the company is because we won a competition that gave us money to start company day one, right? That's the only reason I gave up my job. So I'm not going to pretend as if this is really easy for someone to do. But this is also a scenario where, for example, federal grants, and we see this a lot, right? So for federal grants and contracts, SPR, STRs, the rule is that you actually have to be primarily or majority employed by the company at the time of the award. So you can actually convince the government saying that, look, I am going to join full-time if you give us the money.
I get this.
And that's a very fair play, right? If you can propose everything, you can put down a really strong plan, tell them, look, I've done everything in my power, but without money, I really can't do this. And so if they get the money, then you can. And we've had those situations before. So at least on that side, there's some understanding of the situations that entrepreneurs, some of the mature entrepreneurs are in, not like college kids who can happily give up stuff and start day one in the garage, but some of the more mature entrepreneurs.
Yeah, we have a really successful battery company that just went public called Solid Power. It's a solid state battery. Their CEO was dedicated to not taking any investment capital, and he funded the entire first 5 years through government grants. And now they have a manufacturing facility and everything, so it can be done.
That's pretty amazing. Yeah, that person will be so he will feel really, really fulfilled, or she. Actually, I have no idea.
It's a he.
He, yeah. But that kind of job satisfaction you wouldn't get if you got money easy day one and you did a few things and exited within a year. Just personal preference, I guess.
Yeah. Another question is, so both of you, lots of times it depends on what community a startup is in, where the entrepreneur is located. Sometimes there's not networks nearby, or it's hard to access, but that's where you get a lot of the peer advice, and that's where you get a lot of counseling and advisors who have been there or been financiers or whatever. So what would you advise to entrepreneurs who aren't anywhere where there is a network?
So my advice would be look real closely, because I'm just seeing wonderful programs across the country. So they might not be visible at first, but we work closely with the Kauffman Foundation, and I mean they're investing in every community out there. So really dig deep, look for those incubators, look for the accelerators, look for universities. They have a lot of this activity as well going on. And the other thing that we're doing with some of these other, now they're referred to as ecosystem builders, is trying to come up with an ecosystem building model, because all different parts of the ecosystem have to, kind of have a symbiotic relationship for this thing to work over the long haul, right? So I think in the years ahead, you're going to see a lot more of that, and best practices coming from one community into the other. I know we've partnered with some groups recently on EDA's Build to Scale Capital Challenge, and that's what that's all about, is in these underrepresented communities, or historically the flyover states, how can we drive a sustainable model that will take the entrepreneurs that are there, bring out the angels that are kind of hiding, and have them work together to really drive economic impact.
Yeah, and nowadays, actually, these impact investors are pretty public and vocal about the fact that they want to actively do impact investing. And so it's not hard to Google them and find them around the country. And they are absolutely happy to invest outside of their own ecosystems, because they themselves might be in a really affluent LA society, but they want to fund someone like, sitting somewhere in the Midwest who doesn't have the right kind of access to the capital. And then the other thing, like actually going off of what Patrick said, so all these economic development, organizations and ecosystem builders, entrepreneur support organizations, ESOs, all of them, they're all looking for success cases and examples to show that it is possible to take startups from these under-resourced areas and get them funded. So this is actually, if I was an entrepreneur, very opportunistically, I would look at that as a golden opportunity to become a GOAT with one of these programs, to be the test case, because they will do everything in their power to actually get you there, to be a success case for them. So this is actually a brilliant time to actually get into that. If you're one of the few in that under-resourced area, I would jump and double down and go at it with both hands and legs. As opposed to being in Silicon Valley, where it's really hard to find money for most people because there's so much of it and there's so many startups and so much competition. So it goes both ways. I think I would be really opportunistic about that, and yeah, I would grab that with both hands.
And I think you both spoke almost directly to Colorado. Boulder always was known, or not always, but over the past 25, 30 years, Boulder's been the place to be to get capital to start companies. But in the last 10, 15 years, Denver has been equally as successful, and they have one of the largest startup weeks in the country now. And then up and down the Front Range, Fort Collins and Denver South as well. Everyone's building these networks, just like you guys have talked about. So that's perfect.
Chris, if I can just make a quick comment and then give a stat that I hope will be, motivational to everyone. George asked, what stood out about the last pitch that you invested in? And I responded in there, it was the founder, but I want to just set the stage. So this was a young woman, pre-seed, starting a company. Her father, very successful serial entrepreneur, owned a bunch of grocery store chains, real estate, all that stuff. And I had said to her, hey, why are you going through this round and, raising these funds? Why don't you just go to your father? You're his daughter. He clearly invested in you and all that. And I mean, she came out of her seat with hell no. I'm not going to ask them for anything because I'm going to do this myself. And I don't want my Thanksgiving dinner to turn into a board meeting. And I love that she was going to do this on her own. And she was just so passionate about it. And the final comment here, and I know we're out of time, but our Desert Angels group in Arizona did a 10-year economic impact study. And what they found is that of all the funds that group put in, angel investments, for every $100,000 invested, the portfolio companies produced 5.8 direct jobs, 450,000 in wages, and 2.1 million in economic output. Over that decade, they put in $47.3 million. So you throw that 21x multiplier on economic output and think about what that does to a regional, area. It's huge.
Amazing. Cool. I know we're coming right up on time. So Pat and Rupak, thank you so much for sharing your insights. There's a ton to dig in here. We could have gone for much longer. But quickly, how can folks engage with each of your organizations?
So for us, Angel Capital Association, we're a professional society, 15,000 investors, but we've got all kinds of free resources for entrepreneurs. If you are part of an economic, development organization, we do have economic development memberships and angel groups as well. We have them for both individuals as well as the collective.
Yeah, and then I'm just going to throw the website and my email ID in the chat there. So Turbo SPR is our software that we use to help entrepreneurs with SPR funds. And we have a free tier that has a bunch of options for entrepreneurs to find the right fit with whichever opportunity is out there for them, grant-wise, grant and contract-wise in the federal space. So and that's completely free. So they can definitely use that. And my email ID is there as well. If anyone needed something else from me that I can help with, I would be very happy to.
Fantastic. Cool. I'm also happy to chat with folks. You can find my contact information at riot.org. And let me even hand it back over to Chris with Denver South to give us some closeout comments.
Thanks, guys. I mean, and Rachel, this was really fascinating. I kind of thought I knew everything there was to know about, early stage capital, but I learned a lot today. So appreciate you guys taking your time to join Riot and Denver South. I did want to mention before I signed off that we have hired a new entrepreneurship director. He starts right after the first of the year. His name is Nathan Bishop. He comes to us from the city of Greenwood Village, which isn't part of our region, but he also was involved for a long time with the city of St. Louis and building the ecosystem around Washington University. So he has a lot of experience, and we're looking forward to him growing our entrepreneurial ecosystem to even greater heights. We've enjoyed working with you, Rachel and Tom, and your team all year, and we hope everyone has a great holiday.
Thanks so much. Thank you to Denver South, and great conversation. We'll let everyone go and chew on the things that they learned today.
Happy
Thank
holidays.
you, everyone.
Thanks, Rachel.
Yeah, have a great holiday.